What if I told you that the difference between an ordinary trader and a world-class market champion isn't luck, isn't genius, and isn't some secret Wall Street algorithm, but a mindset, a razor-sharp way of thinking that cuts through fear, noise, and uncertainty. A mental framework so disciplined and so battle-tested that it turned a kid from a rough neighborhood with no money, no connections, and no formal education into one of America's top trading champions. This isn't a fantasy. This is the real story of Mark Minervini, the U.S. investing champion, who didn't just beat the market, he crushed it. And in his book Think and Trade Like a Champion, he reveals exactly how he did it. If you've ever stared at a stock chart and felt unsure, if you've ever taken a trade that felt right but ended in disaster, if you've ever caught yourself holding onto losers and selling winners too early, then this book isn't just helpful, it's a turning point. Because Minervini doesn't sugarcoat anything. He doesn't give you vague motivation or generic trading tips. He gives you the raw, blunt truths that most traders never want to hear, but absolutely need to hear. Like why your biggest enemy in the market is you. Why almost every new trader blows up accounts. Why success has nothing to do with prediction and everything to do with preparation. And why professionals don't hope, they plan. In this video, we're diving into the core principles that made Minervini a legend. How to think risk first, like a true champion. Why planning your exit is more important than picking your entry. How great traders make fewer decisions, but better ones. The surprisingly simple buying rules that help you catch explosive stocks before they run. And the psychological framework that separates the humble winners from the emotional amateurs. But here's the twist. This isn't a book about trading techniques. This is a book about identity transformation. Minervini isn't trying to make you trade like him. He's trying to help you trade like the best version of you, the disciplined, focused, mentally strong version who follows rules, manages risk, and treats trading like a business, not a casino. That's why he emphasizes the habits, routines, and internal beliefs that shape consistent market success. Because the truth is, the market doesn't care about your feelings, your hopes, or your hunches. The market rewards those who can control themselves better than they try to control outcomes. So if you're tired of gambling in the markets, if you're tired of being confused by conflicting advice, if you're ready to understand what separates real champions from crowds of emotional traders, then stay locked in. Because the ideas you're about to hear have helped countless traders turn chaos into clarity, and they might just change the way you see the market forever. Welcome to Think and Trade Like a Champion, where ordinary traders are transformed into extraordinary ones. Chapter 1 of Think and Trade Like a Champion establishes one of Mark Minervini's most important principles. Successful trading begins long before you enter a trade. Minervini argues that most traders fail not because of bad markets, but because they operate without a clearly defined, repeatable plan. The chapter breaks down what a real trading plan looks like, why it matters, and how disciplined preparation separates champions from average participants. Minervini begins by explaining that every trade must have a specific purpose. Traders often buy because something looks good, because they don't want to miss out, or because the stock is moving up today. These emotional triggers destroy consistency. A champion trader instead follows a rule-based approach. Before entering any position, Minervini wants answers to key questions. Where will I buy? Why here? Where is my stop? What is the risk? What is the potential reward? What conditions must stay intact for me to remain in the trade? If a trader can't answer all of these questions in advance, the trade is not valid. A major point emphasized in this chapter is that a plan is not merely a preference. It's a requirement for survival. The market is unpredictable, and once money is on the line, emotions take over quickly. Fear, excitement, frustration, and hesitation can derail judgment. A trading plan acts as a pre-commitment contract, protecting the trader from emotional decisions made under pressure. Minervini frequently repeats that you must make your most important decisions before you are in the trade, not while the trade is moving against you. Minervini also highlights the importance of conditional planning. A good plan doesn't just outline the entry and stop-loss levels. It includes criteria that validate or invalidate the trade after entry. For example, He explains that if the stock fails to behave as expected, if volume fades, price stalls, or relative strength weakens, then the trader must immediately reassess. A strong setup that stops acting strong is no longer a setup. This is the discipline that protects capital. Another core idea is that traders should adopt a mindset similar to professional athletes. Champions do not show up without preparation. They practice, they set goals, and they execute consistently. Minervini stresses that each trading day should have a structured routine, evaluating watch lists, analyzing setups, reviewing risk, and preparing for multiple market scenarios. When the market opens, the trader should already know what to do. There is no guessing, no improvising, and no hoping. The work is done beforehand. Perhaps the most important message of the chapter is that planning increases both confidence and performance. When traders know their risk, know their exit, and know the exact conditions they need to act on, they trade more decisively. Hesitation disappears, panic decreases, and consistency becomes possible. In essence, Chapter 1 teaches that a champion trader doesn't win by predicting. They win by preparing. The market rewards discipline, structure, and clarity, not intuition or impulse. Minervini wants readers to understand that a detailed, tested, and consistently executed trading plan is the foundation of every great trading career. Chapter 2 expands on a core principle of Mark Minervini's trading philosophy. Risk is the first and most important factor in every trade. While many traders start by thinking about how much money they can make, Minervini emphasizes that champions start by asking, "How much can I lose?" This risk-first mindset shifts the entire decision-making process and prevents destructive behavior that leads to major drawdowns. Minervini begins by explaining that most traders underestimate risk because they focus too heavily on potential profits. They mentally project best-case scenarios and ignore the downside until it hits them. According to him, professional traders survive because they constantly assume that every trade might fail. This assumption forces them to calculate risk levels precisely and choose only setups where the potential loss is acceptable relative to the potential reward. A major concept of this chapter is the maximum allowable loss (MAL) before entering any trade. Minervini defines the exact price at which he will exit if the trade does not work. This isn't a suggested level, it's a non-negotiable rule. The MAL is calculated based on the chart structure, volatility, and the trader's personal risk tolerance. Once the MAL is set, the position size must be adjusted so that a stop-out will not damage the account beyond a predetermined percentage. This ensures consistency and protects the trader from emotional, oversized bets. The chapter also emphasizes the importance of mathematical expectancy. Even a strategy with a high win rate can fail if the losses are too large. Minervini stresses that traders must build systems where the average winner is significantly larger than the average loser. This positive expectancy only becomes possible when losses are capped quickly and aggressively. One uncontrolled loss can wipe out the gains from 10 well-managed trades. So the priority is always defense first. Minervini further explains how emotional tendencies distort risk management. Traders often widen stops, average down, or hope that a losing position will rebound. He calls these behaviors signs of an amateur mindset. A disciplined trader instead treats risk as a fixed cost of doing business. Taking a stop loss is not a failure. It's a necessary part of running a professional trading operation. Another important idea in this chapter is avoiding low-quality setups, even if they seem attractive. When risk is the first filter, many trades automatically get eliminated because they require too much downside exposure relative to the potential reward. Minervini argues that staying out of bad trades is just as critical as finding good ones. To him, a trader should wait patiently for low-risk entries where the stop-loss level is clear, the technical structure is supportive, and the probability of a favorable move is strong. Minervini concludes Chapter 2 by stating that risk-first thinking creates long-term durability. Traders who focus on avoiding big losses naturally develop better discipline, clearer decision-making, and more stable equity curves. This approach allows them to stay in the game long enough to capitalize on major opportunities. In the end, risk management isn't just a component of trading, it is the foundation that supports every other. Aspect of a successful trading strategy. Chapter 3 builds on Minervini's risk-first foundation by introducing a critical rule. A valid trade must offer more potential reward than risk every single time. Minervini is direct about this. If the upside does not clearly outweigh the downside, the trade is immediately disqualified. This chapter focuses on how traders can structure favorable reward-to-risk setups and avoid the dangerous habit of taking trades with poor asymmetry. Minervini opens the chapter by explaining that many losing traders reverse the logic of professional trading. They accept large risks in exchange for small possible gains, or they enter trades without quantifying either number. This behavior produces inconsistent, unpredictable results. Champions, on the other hand, measure everything. The potential reward is evaluated based on objective technical factors, not wishful thinking, and compared against the predetermined stop-loss level. If the ratio doesn't meet requirements, there's no trade. A key idea in this chapter is the minimum reward-to-risk ratio, RRR. Minervini's rule is straightforward. The expected reward must exceed the risk by a clear margin. Although he does not insist on a fixed ratio for every situation, he makes it clear that a trader should never structure a trade where the downside is equal to or greater than the potential upside. He describes this as negative expectancy, and he warns that traders who repeatedly take such trades eventually blow up, even if they occasionally hit winners. Minervini also explains that proper reward-to-risk analysis begins with realistic profit targets, not optimistic ones. A trader should identify logical resistance levels, prior highs, trendline areas, or measured move projections to estimate where a stock is likely to encounter selling pressure. This sets a rational expectation for potential gains. Only after identifying the target does the trader compare it to the predetermined stop level. If the potential profit zone is too narrow relative to the risk, the setup is inherently flawed. The chapter emphasizes that position size is always derived from the stop-loss distance, not from excitement, confidence, or the desire to make a certain amount of money. By sizing positions according to risk, traders maintain consistency across all trades. This prevents oversized losses and eliminates emotional decision-making during volatile moves. Minervini points out a common error. Traders often focus on being right, rather than being profitable. They enter trades with tight targets but wide stops, because they are more concerned with avoiding stop-outs than with generating meaningful profits. Minervini rejects this mindset. Professional traders think in probabilities and expect to be wrong frequently. The goal is not to avoid losing trades, but to ensure that losses are small and winners are large. This asymmetry is the engine of a sustainable equity curve. Toward the end of the chapter, Minervini explains that this principle also keeps traders patient. When you refuse to take trades with poor reward-to-risk profiles, you automatically eliminate impulsive decisions. You wait for high-quality setups where both technical structure and price behavior support a favorable asymmetric opportunity. In summary, Chapter 3 teaches that trading success depends less on prediction and more on structuring trades with mathematically advantageous payoff profiles. Never risk more than you expect to gain, because long-term winners are built on discipline, not hope. Chapter 4 focuses on an essential requirement for becoming a consistently profitable trader. You must know the real data behind your performance. According to Minervini, most traders operate with assumptions, selective memory, and emotional bias. They think they know how they trade, but their actual results often tell a very different story. The goal of this chapter is to break that disconnect and teach traders how to analyze their performance with complete honesty and precision. Minervini opens by stating that self-deception is one of the biggest obstacles to improvement. Traders overestimate their win rate, underestimate losses, or believe they are following rules when they are actually breaking them. Without tracking data, a trader has no way to see patterns, identify weaknesses, or measure progress. Professionals analyze their results the same way a business analyzes financial statements. Every number matters. To eliminate guesswork, Minervini recommends maintaining a detailed trading journal. He is not referring to emotional notes or broad reflections, but a structured log containing objective performance metrics. Key data points include entry price, exit price, position size, stop-loss level, maximum adverse excursion, maximum favorable excursion, and reason for entry. This journal should also note whether the trade followed the trader's plan or deviated from it. Over time, this creates a factual record of behavior. A major concept introduced in the chapter is the win-loss efficiency ratio. Minervini emphasizes that raw win rate means very little. A trader could win 70% of the time and still lose money if the losses are larger than the gains. Instead, the real measure of performance is whether the trader's average winner exceeds their average loser. This ratio exposes the truth about expectancy and highlights whether the trader is truly managing risk according to their rules. Minervini also stresses the importance of reviewing category-based performance. He recommends segmenting trades into groups, for example, breakouts, pullbacks, earnings gaps, continuation setups, or low-risk pivot entries. By analyzing each category independently, traders can identify which setups perform well and which consistently underperform. The goal is to stop trading weak categories and allocate more focus to strong ones, creating an efficient edge. Another key point in Chapter 4 is identifying behavioral mistakes. Minervini argues that traders often repeat the same errors, moving stops, entering too early, holding losers too long, or taking impulsive trades outside their strategy. By reviewing journal data, a trader can quantify how much these mistakes cost over time. Seeing the financial damage in real numbers creates accountability and forces corrective action. The chapter also covers the importance of equity curve analysis. A stable upward-sloping equity curve indicates that the trader is following rules and managing risk properly. A volatile or inconsistent curve often signals poor discipline. Minervini encourages traders to study the curve closely, looking for periods where performance deviated from the plan and identifying what caused the drop. Minervini ends the chapter with a clear message: you cannot improve what you do not measure. Traders who rely on memory or intuition are operating blindly, but traders who track, analyze, and confront their performance honestly gain the self-awareness required for consistent growth. Chapter 5 centers on a principle that Minervini considers fundamental to long-term trading success. Compounding works only when you avoid compounding mistakes. Winning traders do not simply grow their capital through profitable trades. They protect that capital by preventing repetitive errors, emotional decisions, and large drawdowns. According to Minervini, the real advantage in trading comes from consistency, not from occasional big wins. Minervini begins the chapter by highlighting a mathematical reality that many traders overlook. Large losses are exponentially harder to recover from. A 10% loss requires an 11% gain to break even, but a 50% loss requires a 100% gain. Therefore, the first rule of compounding is to avoid major setbacks. Minervini emphasizes that the biggest interruptions to compounding are not market volatility, but poor discipline, oversized positions, loose stops, and impulsive trades outside the plan. A major theme of the chapter is the idea of error reduction as a performance strategy. Minervini argues that improving results is less about finding new techniques and more about eliminating recurring mistakes. Common errors include chasing extended stocks, holding losers too long, ignoring stop-loss rules, or trading during periods of low personal clarity or high stress. Each mistake may seem small in isolation, but over time, they accumulate and drain compounding power. Minervini encourages traders to quantify their mistakes using journal data from Chapter 4, transforming vague problems into measurable patterns. The chapter also addresses emotional compounding, a subtle but damaging dynamic. When traders experience a loss, frustration often pushes them into revenge trading or overtrading. When they experience a win, overconfidence leads to oversized positions or unnecessary risks. In both cases, emotion magnifies the original event, causing traders to compound psychological errors instead of capital. Minervini stresses that professional traders break this cycle by keeping position sizes consistent, sticking to predefined rules, and taking breaks when emotions escalate. Another important topic is capital preservation during drawdowns. Minervini emphasizes that even top traders face losing periods. What separates champions is not that they avoid drawdowns, but that they minimize them. He recommends reducing position size, tightening risk parameters, and trading less aggressively when performance declines. The goal is to stop negative momentum before it grows into a damaging equity curve contraction. When you're not trading well, Minervini explains, trade smaller or don't trade at all. Minervini also introduces the concept of compounding opportunities. These are periods when a trader is in sync with the market and their strategy is performing well. During such times, traders can slightly increase position sizes or take more setups, but only within the strict boundaries of their risk rules. Compounding should be applied to strength, not hope. Minervini warns traders not to scale up simply because they want to accelerate gains. Scaling up should only occur after a proven period of strong execution and favorable market conditions. The chapter concludes with a clear message: the power of compounding belongs to disciplined traders. You compound money by protecting your capital, staying consistent with your rules, and avoiding the temptation to repeat emotional or impulsive mistakes. Small edges, applied over long periods, create exponential results, but only if mistakes are not allowed to accumulate faster than gains. Chapter 6 marks a major transition in the book, as Minervini shifts from mindset and risk management into the mechanics of buying stocks correctly. This chapter explains the precise conditions that define a high-quality entry, why timing matters, and how traders can dramatically improve results by selecting stocks that show certain technical and fundamental characteristics. Minervini emphasizes that buying correctly is not about prediction. It is about aligning with strength, structure, and statistical advantage. Minervini begins by stating that most traders buy too early, too late, or for the wrong reasons. They react emotionally to price movement rather than waiting for a structured entry point. In contrast, champion traders wait for what Minervini calls low-risk entry zones, where the reward-to-risk profile is favorable, the trend supports the trade, and the stock exhibits clear signs of institutional accumulation. A central concept introduced here is the volatility contraction pattern (VCP), although Minervini explores this pattern in more depth later in the book. Chapter 6 outlines the foundation. Strong stocks often tighten their price action as they move toward a breakout point. This contraction reduces downside risk and signals that supply is drying up. The goal is to buy as the stock emerges from this tightening action, where the stop loss can be placed close to the entry, creating optimal asymmetric reward. Minervini also emphasizes the importance of relative strength. A stock should outperform the market and its sector before it becomes a candidate for purchase. Winners show strength early, not after the move is already over. He instructs traders to rank stocks by performance, focusing only on the strongest names in the strongest groups. Weak stocks, even if they appear cheap, have statistically poor odds of delivering big gains. Another essential principle in Chapter 6 is buying only in confirmed uptrends. Minervini rejects bottom picking entirely. He argues that buying a stock because it is down oversold or looks cheap is one of the most common amateur mistakes. Professional traders buy strength, not weakness. The trend must be up, the moving averages must support the structure, and the stock must display constructive behavior. A true leader behaves like a leader long before it makes a major move. Minervini also explains the importance of proper base structures. Good entries come from healthy consolidations, not from chaotic or deep pullbacks. He describes the characteristics of constructive bases: tightening price ranges, declining volume during pullbacks, support at key moving averages, and clear pivot points where breakouts are likely to occur. If a base is too loose, erratic, or V-shaped, the probability of failure increases. Another key lesson in the chapter is the distinction between setup versus trigger. A stock can have a strong setup, good fundamentals, strong relative strength, constructive base, but it only becomes actionable when it triggers a breakout or meets the precise conditions of the entry. Many traders enter too soon because they are excited by the setup, forgetting that timing is the true edge. Minervini concludes Part 1 by stressing that buying correctly sets the entire trade up for success. A tight, well-timed entry allows for smaller stops, larger position sizes with controlled risk, and better psychological comfort. When you buy right, Everything that follows becomes easier when you buy wrong. Everything becomes harder. Chapter 7 continues Minervini's deep dive into the buying process, refining the criteria and timing techniques needed to execute high-probability entries. If Chapter 6 explains what to look for in a setup, Chapter 7 explains how to act when the setup triggers, how to avoid premature entries, and how to position yourself for maximum upside with minimum risk. Minervini opens the chapter by emphasizing that the buy point must be precise. Many traders identify a strong stock but enter randomly within the base or consolidation. This approach inflates risk and reduces the reward-to-risk ratio. Minervini stresses that the correct buy point is the pivot, the exact moment price breaks out of a tightening pattern with strength. A good pivot is not subjective. It is defined by clear technical behavior, such as decisive upward price movement and supportive volume. A core concept expanded in this chapter is the volatility contraction pattern VCP breakout trigger. Minervini explains that proper VCP entries require not just contraction, but also confirmation. A stock should break above the final contraction area with convincing momentum. Volume does not always need to be extreme, but it should be noticeable and supportive, indicating institutional participation. This breakout point is where the trader can place a tight stop loss, just below the most recent contraction, optimizing risk controls. Chapter 7 also addresses the danger of chasing extended breakouts. Minervini warns that traders often enter too late, after the breakout has already run far beyond the pivot. When the distance between the breakout point and a logical stop grows too wide, the trade becomes low quality, even if the stock is fundamentally strong. The lesson: a good stock bought at the wrong time becomes a bad trade. The edge lies not in the stock itself, but in how tightly the trader can control risk at the entry. Minervini then discusses the importance of multiple timeframe alignment. A breakout on the daily chart should align with a supportive structure on the weekly chart. Constructive bases, rising moving averages, and overall trend confirmation. Weak or inconsistent weekly structure often leads to failed breakouts, so traders must analyze both time frames before acting. Another important point is buying with confirmation, not anticipation. Many traders try to predict a breakout before it occurs to get a head start. Minervini rejects this approach, arguing that it increases the probability of fake breakouts, shakeouts, or deeper pullbacks. Champion traders wait for the market to confirm their thesis. Only when the stock proves its strength with actual price action does the trade become valid. Minervini also explains the value of dry-up volume, moments when volume contracts significantly during the tightening phase of a base. This signals that selling pressure has diminished. When a breakout occurs after a dry-up period, the move tends to be more sustainable because few sellers remain to push the stock back down. The chapter concludes by reiterating that buying is not just about spotting good stocks. It is about timing your entry with precision and discipline. When traders combine strong setups with clean pivots, VCP structure, proper confirmation, and alignment across time frames, they place themselves in front of high-probability moves while maintaining strict risk control. Chapter 8 addresses one of the most critical yet misunderstood components of trading: position sizing. Minervini stresses that even the best stock selection and timing can fail without proper control over how much capital is allocated to each position. Position sizing determines risk, affects emotional stability, and ultimately shapes the trajectory of a trader's equity curve. The chapter explains how professionals size positions systematically instead of emotionally. Minervini begins by explaining that position sizing must always be calculated from the stop-loss level, not from the amount of money a trader feels like committing. This aligns with his risk-first philosophy. All trade size decisions start with defining the maximum allowable loss MAL. Once a trader knows exactly where the stop-loss will be placed and how much they are willing to lose, e.g. 0.3% to 1% of total equity, the position size becomes a mathematical output, not a guess. He emphasizes that most traders do the opposite. They choose a share amount first and then adjust the stop around it, introducing emotional bias and inconsistent risk exposure. By reversing the process, traders ensure that every trade carries a uniform, Predictable level of risk. A major concept in this chapter is the risk unit approach, where each trade risks a fixed percentage of total equity. This eliminates large, unexpected losses and keeps the equity curve stable. Minervini explains that when a trader risks too much on a single trade, a normal stop-out can become psychologically destabilizing. When losses are small and controlled, discipline is easier to maintain, and decision-making remains objective. The chapter also covers the importance of adjusting position size based on volatility and setup quality. High volatility stocks require smaller positions because their stop distances tend to be wider. Lower volatility stocks may allow for larger position sizes because their price movement is more contained. Additionally, Minervini argues that traders should size up only when setups are clean, tight, and structurally strong, not simply because they feel confident or want a big win. The quality of the setup dictates the size, not emotion. Minervini warns against over-concentration, a common mistake among aggressive traders. Concentrating too much capital into one or two positions magnifies risk and can result in significant drawdowns if those trades fail. While Minervini sometimes takes larger positions in special situations, he emphasizes that this should only be done when risk can still be tightly controlled. In most cases, diversification across several strong setups reduces portfolio-level volatility. Another section of the chapter discusses adding to winning positions. Minervini advocates for pyramiding in a controlled, structured manner, only after the trade has confirmed strength and moved in the trader's favor. Add-ons must also follow strict risk parameters. Not every winner deserves an increase in size. The goal is to build positions methodically, only when the market proves the trader right. Minervini also highlights the importance of reducing position size during periods of underperformance. When a trader is not aligned with market conditions or is making errors, trading smaller helps protect capital and prevents drawdowns from accelerating. The self-regulation keeps traders in the game long enough to benefit from future opportunities. Chapter 8 concludes by reinforcing that position sizing is the backbone of risk control. A trader who sizes consistently can survive losing streaks, reduce emotional volatility, and maximize the compounding effect of high-quality setups. In Minervini's view, position sizing is not just a risk tool. It is a performance weapon that separates disciplined traders from inconsistent ones. Chapter 9 addresses one of the most difficult skills in trading: selling correctly. Minervini states that most traders obsess over entries but neglect exits, even though exits ultimately determine profitability. A great buy can still lead to a losing trade if the exit is poorly managed. This chapter provides a structured framework for selling into strength, protecting profits, and avoiding the emotional traps that cause traders to hold too long or sell too soon. Minervini begins by explaining that selling should be planned before the trade is entered. Traders must define 3 key areas in advance: the stop-loss exit protecting capital, the technical exit when the chart loses constructive behavior, the profit-taking exit when the stock reaches predetermined targets. Having these categories prevents reactive decisions during volatility without pre-planning. Emotions drive exits, and emotions often push traders to the worst possible choices. A major theme in this chapter is selling into strength. Minervini emphasizes that professional traders rarely wait for tops. Instead, they lock in gains methodically as the stock moves upward. This approach reduces pressure, secures profits, and keeps the trader psychologically balanced. Selling into strength also ensures that the trader exits when liquidity is high and slippage is low, rather than during a sudden pullback when everyone else is rushing to sell. Minervini stresses that stocks often give clear signals when momentum is weakening. These include lower highs on shorter time frames, breaks below key moving averages, loss of tightness in price action, failure to follow through after constructive setups, distribution days or heavy selling volume. When these signs appear, the trader should not hesitate. The goal is not to catch the absolute top but to preserve gains while the stock is still in a favorable position. The chapter also discusses overstaying winners, one of the most common amateur mistakes. Traders often become emotionally attached to profitable positions and begin rationalizing negative behavior widening stops, ignoring breakdowns, or expecting the stock to resume its trend. Minervini warns that strong stocks can deteriorate quickly, and the cost of holding through a breakdown is often far greater than the benefit of squeezing out a few extra percentage points. Another important concept is scaling out, which Minervini uses to balance profit-taking with staying in a potential big move. He suggests taking partial gains at logical resistance levels or after extended runs, then holding a reduced core position as long as the stock maintains constructive patterns. This method protects profit while keeping the trader involved in potential long-term winners. Minervini also covers failed breakouts, explaining that not every breakout leads to follow-through. Traders must be willing to exit quickly if the breakout loses momentum or falls back into the base. Quick exits prevent small losses from turning into major setbacks. The chapter concludes with an overarching message: selling is about discipline and clarity, not prediction. A trader who masters the sell rules naturally produces more consistent and stable returns, because they avoid catastrophic losses and systematically lock in gains. Minervini reinforces that selling well requires structured thinking, predefined criteria, and emotional neutrality, not hope, fear, or gut feeling. Chapter 10 outlines the core factors that allow traders to achieve what Minervini calls superperformance, outsized returns that significantly exceed market benchmarks. These 8 principles form the structural foundation of Minervini's trading methodology. They are not shortcuts or tricks. They are repeatable behaviors and criteria that consistently appear in the early stages of the market's biggest winners. Minervini begins by clarifying that superperformance is not based on prediction or luck. It is the result of identifying stocks that meet specific technical and fundamental conditions, while applying disciplined execution. The chapter emphasizes that traders who want exceptional results must adopt an evidence-based framework rather than trading based on opinions or market narratives. Key 1. Strong earnings and sales growth. The first key is accelerating fundamental performance. Most major winners show strong quarterly earnings growth, often 25% to 50% plus, expanding margins, and rising sales. Minervini stresses that traders should not settle for mediocre fundamentals. Exceptional price moves typically occur in companies experiencing real business momentum, not those with stagnant or declining metrics. Key 2. Leading stocks in leading groups. Minervini highlights the importance of industry group strength. Historically, the largest winners tend to come from the strongest sectors during a given market phase. Traders should focus their attention on top-performing groups and, within them, the leading stocks showing the highest relative strength. Key 3. Proper chart structures. Technical structure matters. The best stocks form constructive bases, such as VCP patterns, flat bases, and shallow consolidations. These bases show tightening price action, declining volume, and clear pivot points. Minervini warns that loose, wide, or volatile patterns often fail and should be avoided. Key 4. Superior relative strength. Before breaking out, superperformers display persistent outperformance versus the overall market. Minervini encourages traders to rank stocks based on relative strength metrics and favor those consistently in the top percentile. Market leaders reveal themselves early. Key 5. Confirmed trend alignment. A proper uptrend is non-negotiable. Superperformers almost always emerge from already rising trends. Minervini rejects bottom fishing. He insists that the stock must be above major moving averages, showing higher highs and higher lows. Trend alignment increases the probability of sustained follow-through. Key 6. Discipline in execution. Technical and fundamental factors matter, but execution determines whether those advantages convert into profits. Minervini emphasizes waiting for breakout confirmation, respecting stops, and avoiding anticipation. Superperformance requires rule-based entries and exits, not emotional decisions. Key 7. Risk management at every stage. Minervini reinforces that superperformance is impossible without aggressive protection of capital. Traders must avoid large losses, size positions correctly, and reduce exposure when conditions weaken. Preserving capital during tough periods allows traders to fully exploit strong phases when opportunities appear. Key 8. Psychological mastery. The final key is mental resilience and discipline. Super performance requires consistency, patience, and the ability to follow rules even when emotions push in the opposite direction. Traders must resist the urge to chase, panic, or deviate from their system. Minervini ends Chapter 10 by stressing that these 8 keys work synergistically. A trader who consistently applies them develops a repeatable edge. One that makes super performance a realistic, achievable outcome rather than a rare anomaly. Chapter 11 concludes the book by focusing on the psychological framework that supports every rule, technique, and strategy discussed earlier. Minervini emphasizes that the mindset of a champion trader is not motivational fluff. It is a set of trainable mental habits that determine how consistently a trader can execute their system. Skill and knowledge matter, but mindset determines whether those skills are applied with discipline. Minervini opens with a direct point. Most traders fail because they cannot control themselves, not because they lack information. They break rules during emotional moments, lose confidence during drawdowns, or act impulsively during periods of excitement. Champion traders, on the other hand, maintain composure, follow predefined rules, and keep their actions aligned with long-term objectives rather than short-term emotional impulses. A key concept in this chapter is the importance of self-belief grounded in competence. Minervini explains that confidence should not come from hope or optimism, but from having a proven process. Traders who journal, measure performance, manage risk, and operate systematically naturally develop legitimate confidence. This confidence enables decisive execution and reduces hesitation during critical moments. Another essential mental skill is emotional neutrality. Minervini explains that traders must treat wins and losses with the same level of calm objectivity. Big wins can create overconfidence, while losses can trigger fear or frustration. Both emotional extremes lead to poor decision-making. Champion traders stay focused on process, not outcome. They understand that losses are part of the business and do not allow any single trade to influence their identity or behavior. Minervini also discusses discipline as a competitive advantage. Many traders know what they should do, but few actually follow through consistently. Discipline becomes a differentiator. This includes sticking to stop losses, avoiding low-quality setups, preventing overtrading, and refusing to let external noise, news, opinions, online discussions override the trading plan. A champion trader protects their mental environment as carefully as their capital. The chapter emphasizes patience as a critical mindset component. Successful traders are highly selective. They wait for ideal setups, clean entries, and supportive market conditions. Minervini explains that impatience leads traders to force trades that do not meet criteria, often resulting in unnecessary losses. Patience is what allows a trader to stay aligned with high-probability opportunities. Another important topic is handling drawdowns. Minervini states that every trader, no matter how skilled, will face losing periods. What matters is how they respond. Champions reduce position sizes, slow down, reevaluate their performance, and protect capital. They avoid revenge trading and maintain perspective. Drawdowns are temporary for traders who adjust quickly and avoid compounding mistakes. Minervini also highlights the value of a growth-oriented mindset. Champion traders continuously review data, identify weaknesses, and refine their process. They understand that improvement is ongoing, markets evolve, and trading systems require periodic adjustments. A fixed mindset leads to stagnation. A growth mindset supports long-term mastery. The chapter concludes with Minervini reinforcing that mindset is the glue that holds the entire trading methodology together. Strategies, setups, and technical patterns only work when executed with discipline, patience, and emotional control. The champion mindset ensures that traders stay consistent, protect their capital, and stay aligned with the behaviors that drive super performance. Think and Trade Like a Champion by Mark Minervini is a complete framework for developing professional-grade trading skills. The book combines risk management, disciplined execution, market structure analysis, entry timing, and psychological mastery into a unified system designed to help traders achieve consistent results. Minervini's message is direct. Trading success is not built on prediction, luck, or complicated theories. It is built on rules, structure, and personal accountability. The foundation begins with planning. Every trade requires predefined answers: where to buy, where to place the stop, how much to risk, and what conditions must remain intact. Without a plan, emotional impulses take over. Minervini then reinforces a risk-first mindset. The trader's primary job is to protect capital. This means defining the maximum allowable loss for every position, ensuring the potential reward is greater than the risk, and rejecting any setup with poor asymmetry. The book then transitions into understanding performance through data and self-analysis. Traders must track results, categorize setups, measure expectancy, and confront mistakes honestly. Compounding only works when errors are minimized, which is why discipline, consistent execution, and avoiding large losses are essential components of sustainable growth. Chapters 6 and 7 provide Minervini's detailed process for stock selection and entry timing. High-probability trades begin with strong fundamentals, sector leadership, superior relative strength, and constructive technical structures. The volatility contraction pattern (VCP) plays a central role. Tightening price action shows supply drying up, creating optimal breakout conditions. Precise pivot entries and confirmation signals help traders avoid premature or extended buys. Position sizing receives its own emphasis. Minervini makes clear that trade size is a function of risk, not emotion. Sizing should be consistent, volatility adjusted, and reduced during drawdowns. Pyramiding into winners is acceptable, but only when price action proves the original thesis correct. Selling, covered in Chapter 9, is framed as a structured discipline. Profits should be taken into strength, breakdowns must be respected, and exits should be planned before the trade is initiated. Predicting tops is unnecessary. Protecting gains is mandatory. The book concludes with the champion trader mindset, a mental framework based on patience, emotional neutrality, consistency, and continuous improvement. Traders must detach their identity from outcomes and maintain discipline regardless of wins or losses. Mindset is the mechanism that allows all technical rules to function effectively. Overall, Think and Trade Like a Champion provides a complete, rule-based model for professional trading. The principles are simple but not easy. They demand discipline, self-control, and a long-term commitment to process. Minervini's framework shows that the path to super performance is built on mastering yourself as much as mastering the market. If this breakdown helped you understand Minervini's approach, make sure to hit that like button, subscribe, and turn on notifications so you don't miss the next deep dive into the world's best financial books. Drop a comment below and tell me, which trading principle do you want to master next? Your engagement helps the channel grow and it tells YouTube this is the kind of content investors actually want to see. Let's keep leveling up your trading game.